the U.S. dollar definitely plays into investing in emerging markets and frankly into global markets just because the risk and how powerful the dollar can be in terms of the swings. Our outlook for the dollar actually, and we have an economist, Cem Akaric, who focuses on Fed policy and global monetary policy. Now, we believe that actually the dollar should be pretty neutral to potentially weak. So you have a very accommodative Fed right now. The Fed is in the process of actually changing their monetary policy framework, which is pretty amazing. There's a big contingent at the Fed led by some of the governors that want to target inflation running hotter than 2% for longer. And so we believe that this could cause the dollar to potentially weaken over time. Additionally, the deficit in the U.S. is $1 trillion. So it's a they're running a pretty wide fiscal deficit at the same time that they're running a current account deficit. If you were to take the current account deficit stats and the fiscal stats of the U.S. and compare it to any emerging market, or not name it, it would look like it's just about due for a currency crisis, frankly. So now the benefit of the U.S. is they do have a currency that is a reserve currency, and if you look at oil, if you look at gold, everything's traded in dollars, so you have that benefit. But our view is that the risk is to a weaker dollar. But I think that supports the case for emerging markets at the margin. I mean, I think if we see a dollar that kind of is stable to trending weaker at a time when emerging market currencies are competitive, then that should set up for good, strong global growth, strong domestic growth for those EM countries. That's also supported by the fact that we are in an incredibly low interest rate environment. The world is really pretty flooded with excess savings. And we see that LVMH just issued bonds at negative interest rates, which is phenomenal to buy Tiffany's. So why would you not issue negative interest rate debt and buy an iconic brand like Tiffany's? Seems like a no-brainer, $15 billion acquisition. But we've seen debt flow into emerging markets, and that's very, very supportive of what I discussed earlier in terms of bringing down nominal interest rates locally, increasing credit into those markets, driving growth overall. And even though investors might not think that they're buying emerging market debt, but when you invest in a global bond fund, they're not buying negative interest rates in Europe. They're buying U.S. high yield, they're buying global high yield, they're buying emerging market debt. And so we continue to see very, very strong inflows into the emerging market debt. And I think that's really going to set up for that very, very strong market backdrop and really a bull market in emerging markets.